Hey everyone, and welcome back to the channel. Today, we read diving deep into a topic that's on everyone's mind, the current state of the market. I get so many questions, so many comments, people asking, what's going on? Should I be buying, selling, or just sitting on my hands? And the truth is, there's no simple one size fits all answer because everyone's perspective on the market is completely different. It really depends on where you stand, your level of experience, and how you interpret the signals. People who have been in this game for a while, who have navigated through different market phases, they tend to see things through a different lens. They understand that cycles are a fundamental part of how markets work. But here's the key insight. These cycles are only relative. What does that mean? It means you can't just look at a chart, see an upward trend, and assume it will go on forever. Nor can you see a dip and immediately panic, thinking it's the end of the world. To truly understand a cycle, you have to zoom out. You have to look at it from a macro level. This isn't just about price action. It's about a whole confluence of factors. You need to consider the psychology of the crowd. What is the general sentiment? Are people euphoric and overly optimistic, or are they fearful and pessimistic? This mass psychology is a powerful driver of market movements. Then you have to look at the psychology of the traders themselves, the professionals, the institutions. Are they accumulating or are they distributing? Are they hedging their bets? Their actions often tell a different story from the public narrative. And it doesn't stop there. There are so many other signals we need to monitor to get a clear picture of which stage of the cycle we're in. We look at economic data, interest rate policies, geopolitical events, and even the type of news that's making headlines. Are we seeing stories of overnight millionaires and speculative frenzy? Or are the headlines dominated by talk of recession and uncertainty? All these pieces fit together to form a larger puzzle. That's precisely why, at this particular stage, you see experienced market participants becoming more cautious. It's not about being bearish or predicting a crash. It's about being prudent and recognizing the shifting dynamics. So, why am I always extra careful at this stage? Well, you don't have to look far. Just observe the news cycle. Pay attention to what's happening in major markets, like the US market. What you'll notice is that things are entering a very, very heated phase. When you see widespread media coverage, when your friends who never talked about investing are suddenly giving you stock tips, when you see a surge in speculative assets with little to no fundamental value, these are classic signs of a late stage bull market. It's a phase characterized by high levels of excitement and, frankly, a bit of recklessness. Everyone feels like a genius because everything seems to be going up. This is the point where the risk becomes greatest because the higher you climb, the further you can fall. It's easy to get caught up in the hype, but this is exactly when we need to be most disciplined. Let's break down this idea of crowd psychology a bit more because it's so crucial. Markets are driven by two primary emotions, greed and fear. In the early stages of a bull market, there's a lot of skepticism. People are still recovering from the last downturn. They're hesitant to get back in. As prices start to recover, optimism slowly builds. Then, as the market continues to climb, that optimism turns into excitement, and eventually it can morph into full-blown euphoria. This is the point of maximum financial risk. It's when people start making emotional decisions, chasing quick profits, and ignoring fundamental warning signs. Conversely, think about a bear market. It starts with anxiety as prices begin to falter. That anxiety turns into denial. People think it's just a temporary dip. Then comes fear, which can escalate into desperation and finally capitulation. Capitulation is the point where everyone gives up. They sell everything, convinced that prices will never recover. And ironically, that point of maximum pessimism is often the point of maximum financial opportunity. So, where are we now in that emotional spectrum? That's the million-dollar question. If you look around, you can see signs of significant optimism, bordering on euphoria in certain sectors. The narrative is powerful. We hear about new technologies that are going to change the world, and there's a sense of this time is different. And maybe it is. But history teaches us that while the details change, human psychology tends to remain remarkably consistent. The temptation to believe that the old rules no longer apply is strongest at the peak. This is why a macro perspective is non-negotiable. You have to consider what central banks are doing. For years, we've been in an environment of low interest rates and quantitative easing, which has pumped a lot of liquidity into the system. That money has to go somewhere, and a lot of it has found its way into financial assets, pushing prices higher. But now the landscape is changing. Central banks around the world are starting to tighten their policies to combat inflation. This means they are reducing the flow of money. Historically, this has acted as a headwind for asset prices. It doesn't guarantee a downturn, but it certainly increases the probability of one. It changes the risk-reward calculation. When I talk about being cautious, it's not about hiding in a bunker and selling everything. It's about being strategic. It's about maybe taking some profits on positions that have had incredible runs. It's about rebalancing your portfolio to make sure you're not overly exposed to the riskiest parts of the market. It is about holding a bit more cash so you have the flexibility to take advantage of opportunities, if and when they arise. Remember, in the market, cash is not just cash. It's an option. It's the option to buy when others are forced to sell. The heated phase we are seeing is also visible in valuations. Are companies trading at reasonable prices relative to their earnings and future growth prospects? In some cases, the valuations are stretched to historical extremes. People are paying prices that imply decades of perfect, uninterrupted growth. That's a very high bar to clear. When expectations are that high, any disappointment, a missed earnings report, a change in regulation, a new competitor can cause a sharp and sudden price correction. So, what's the actual takeaway from all of this? First, educate yourself. Don't just follow the headlines or take tips from social media. Understand the concepts of market cycles, investor psychology, and macroeconomic factors. Second, have a plan. Before you invest a single dollar, you should know your goals, your time horizon, and your risk tolerance. Your plan should also include rules for when you will buy, when you will sell, and how you will manage your positions. A plan helps remove emotion from the decision-making process. Third, stay humble. The market has a way of humbling even the smartest people. No one can predict the future with certainty. Anyone who tells you they know exactly what the market is going to do next is either lying or delusional. Our job as investors is not to predict the future, but to prepare for different potential outcomes. We manage probabilities, not certainties. Right now, the probability of increased volatility is high. The conditions are ripe for it. The combination of high valuations, euphoric sentiment, and a shift in central bank policy creates a fragile environment. It doesn't mean you should be terrified, but it does mean you should be prepared. Think of it like this. When you see dark clouds gathering on the horizon, you don't necessarily run inside and lock the door, but you might bring an umbrella with you. That's what being cautious in this market is all about. It's about having your umbrella ready. As we move forward, we'll continue to monitor these signals together, the economic data, the market sentiment, and the policy changes. The key is to remain adaptable and objective. Don't fall in love with your positions and don't get married to a single narrative. The market is a dynamic, ever-changing environment, and our strategy needs to be just as dynamic. Thank you so much for tuning in today. I hope this discussion gives you a clearer framework for thinking about the current market and how to navigate it. If you found this helpful, please hit that like button and be sure to subscribe so you don't miss our future updates. I'd love to hear your thoughts in the comments below. What signals are you watching? How are you positioning yourself? Let's continue the conversation down there. Stay safe, stay informed, and I'll see you in the next video.